Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 9th, 2025. S&P 500 currently sitting at 5668. I'm David Zarling. I'm here with Ian, to be frank, McMillan, and you just indicated that you are ready to talk about markets.
Yeah.
What should we start with?
Going on out there? Stocks continue to, I guess we didn't do too much this week, but they're holding in there. I would say There's been a few opportunities over the last week or two that come to mind where, I don't know, bears really had a chance to do something. Haven't done it yet, though.
Yeah, we continue to see volatility cool off using the VIX. I mean, still sitting, above 20, 22 to be exact. So 1% moves or greater than that can be expected on a daily basis. But for the past week or so, not a tremendous amount of movement. And we're sitting at below this very important level. After moving quickly off of the April lows, we're still sitting below this 5,600 to 5,800 area that we've talked with clients about several times. And why is that important? Well, there's an election gap from the presidential election. There's the 200-day moving average. There's the start of the year, which we call the zero line, where January 1st price is. And then the prior, if you want to call it an impulse move from the end of March 25th, is also still overhead. And that all sits in the 5,600 to 5,800 level on the S&P 500.
2024 highs.
Yep. So all those things are here, and what they are is just an area of interest. I can't tell you, what the market's going to do, but all I know is that this is an area that's important. There's flags everywhere, whether you want them to be green or red or orange or yellow, don't really care. But we do have levels that buyers and sellers have interacted in frequently that are right here, right now in this 5,600 to 5,800 level. So it's really about observing the buyers and sellers in this area to see what happens. Do we slice through it higher like a knife through butter? That would be tremendous information that this was likely just a blip on the radar, a pretty large one. But if we consolidate here, also would be healthy to chew through potential supply and then move higher. Or do sellers regain control here? That's really three of the major outcomes in this area that you'd be looking for.
None of the four major indices are above their 200-day.
Yep.
I think two, S&P and NASDAQ are above their anchored volume weighted average price from all-time highs. So yeah, still a mixed bag, but there are things above a 200-day, aerospace and defense, gold. Our Bitcoin friends back above 91,000.
Yeah, Bitcoin looks pretty good on an absolute and relative basis.
Looks very good, holding in there. And there's a few other cryptos that have held in there, although I would say the breadth there isn't incredible. Yes, I guess the king of them all, Bitcoin, is held in well, but there's only maybe 20% of cryptos that are above their respective 200-day moving average.
Okay.
So, and I mean, a lot of them got hit hard. Obviously, probably not as much headline. No one's out talking about starting a Ethereum sovereign wealth fund or whatever the government is talking about. I think there's a few states that are starting Bitcoin funds as well. Fascinating era we are in.
It is. But to your point, Bitcoin looks good. Ripple looks good. Tron looks good. Obviously, those aren't recommendations, but just interesting to note, during April's volatility to the downside, those did hold up well. And that's worth paying attention to. Maybe those are the beach balls that were pushed underwater going forward. And if we move through the 5,800 level, maybe we do see some of these crypto names that we just talked about be leaders. Time will tell. We have in the background, we talked about the Zwig breath thrust the last few weeks here. We did record one of those that has strong statistical significance 6 to 12 months out, still within the first 6 months. And also in the background is a negative 6 month return during the seasonally strongest 6 month period of November through April.
Don't like that.
Yeah, I got to keep that in mind. But internationally, some really nice developments. European financials still showing absolute and relative strength. I'm not sure many people had that. There's always people talking about stuff that don't know anything that they're talking about. But when you use charts, it's pretty easy to see that European financials have had strength, both on an absolute and relative basis. And that's good. What else are we seeing internationally, Ian, that our listeners might?
DAX.
The DAX.
Getting a little up there, though. DAX is finding a 2.618 extension from its 2022 bear market correction.
Look at you using a Fibonacci extension.
So it's there. It can definitely go through it. That extension actually takes you to over 30,000 on the DAX. So that would be another 30%. We're sitting at 23. Probably another roughly 30% higher. Yeah, about exactly 30%, 29, 30%. Can you believe that?
Yeah, you're going to get a DAX 30,000 hat?
That would be sweet. I still can't find Dow 40,000. I've looked on eBay for 2 years. I just have to get one made.
Yeah, you just got to. It's the new world we're in. You probably could.
Feels jinxy, though.
As soon as you get the hat, we lose. We lose the 40,000 level.
Yeah.
Well,
We've only been above 40,000 since, not even a year.
Well, and it's important to highlight that, why I talk about the DAX. Well, one, on the verge of new all-time highs here. Two, highly correlated to U.S. markets.
Yeah, if DAX is fine, then the U.S. is probably going to be fine.
Right. And you also have, you mentioned the Dow Jones. Some love it. Some call it archaic because it's a price-weighted index, but it's got usefulness. Papa Dow.
It does.
It's got correlation, and I think it's going to have some problems here if United Healthcare can't get it together.
Yeah, that's a terrible looking chart. And that's what down. You said it's the third in the rankings now. Used to be number one.
Right.
And Goldman's up there. Goldman and can't remember the other one off the top of my head.
But we can talk about health insurance stocks here in a moment, but finishing up our international discussion points here. I mean, you're still seeing strength out of Poland, still seeing strength out of Greece. There's opportunity. Mike Zaccardi, a quality technician, he pointed out a classic move here that the Frontier Markets ETF shut down. And after being delisted, Frontier Markets are doing just fine right now. Isn't that fascinating?
Never fails. Never fails.
The suggestion was made, maybe we launch ETFs that closed.
There you go.
Which is a mental gymnastics, because is it then self-fulfilling that they...
Well, then that means we got to have to start an ESG ETF.
Yes. ESG. Well, and you wonder if pot stocks are next. YOLO, Toke, MJ.
Gosh, terrible. They participated in nothing.
Yeah, they no bounce. Maybe a little for some of these, but
some of them. But they're in there kind of with long-term treasuries.
Ooh.
Terrible. Treasuries, we talked about this in the client letter again this month. Yeah, have not come down. Upper end of the range that they've been in since, October 2023 about. Call it 18, 19 months. They're not ripping higher, but they're not rolling over either. That could happen. Maybe we found a sweet spot.
Well, yeah, I mean, rates using TNX as 10-year yields or TYX for 20+ year yields, still range bound going back to late 2023. So holding up pretty steady here. And, you could see a situation where this consolidation, I think we have to acknowledge that we have an uptrend in rates since 2020. And if we have a consolidation, as a technician, you observe the consolidation because the likelihood of a consolidation breaking in the direction of the primary trend, which is up, is a higher probability than the opposite. But if the opposite were to happen, you'd want to pay attention to that. But right now, this consolidation is one that likely for rates indicates higher rates in the months to years to come.
Yeah, most listeners know we've been on that train for a while. It is what it is.
Yeah, how's the service on the high yield train?
Doesn't make me jump for joy, but probably good for society in the long run if we can get back to, charging for debt what it really costs.
Right, the cost of money.
The cost of money. ZERP was fun, but the can was kicked too far. And I have friends that text me things like, "Oh, is the bond market broken?" Or, I don't think anything is broken. Right. I don't think anything in any type of market, in any type of liquid, publicly traded market is really ever broken. It just is what it is. And we were having a conversation. I think we are going to have to go through an entire generation. So starting probably with the kids now coming out of college, we're going to have to go through an entire generation of people who have mortgages above 6% for this to settle in like where we're at. I really don't think there is broad acceptance of higher interest rates. And then this is to use a media term, this is your new normal. And it's the old normal.
Right.
Like it sounds weird saying that. ZERP was the weird. It was cool. No one's complaining over free debt, right? No one was going to whine about that for however long we had it, 10 years. And people say, you want the house you can afford? This is how we get there.
Well, and we know that the normal for rates is a 35 to 40 year cycle from trough to peak and peak to trough. And so it's likely that your sons will be my age when we're talking about how high rates are and they're turning the other way and starting to lower. 60-40 portfolio will be a distant memory at that time. That will be frowned upon, that you would have that much exposure to bonds that are declining in price, which is that relationship between bonds.
The 40 will be Bitcoin.
Could be.
Could
absolutely be. No problems there. But yeah, there's international strength, treasury weakness. We have CCC credit spreads have continued to cool off, which is that indicator of improved liquidity, less financial stress. Really, you'd like to see that continue. If we're going to clear this 56,800 on the S&P, you're likely seeing that environment with cooling CCC credit spreads. We have to see that yet. But some interesting developments out there, financials overall holding up well domestically and internationally. But consumer discretionary is kind of a mixed bag. I mean, you've got Home Depot, Lowe's, and Starbucks versus the S&P all struggling, while Tesla and Amazon are holding on so far. I mean, those are pretty large weightings in something like XLY. But is it hiding some things underneath the surface? Time will tell.
What do you think about Apple? Apple gross the last week or so.
Yes. Apple does not look great.
Yeah, that does not exude confidence. And I'm not saying the market can't go higher. It will be a headwind, but Apple looks not like a market leader.
Correct. I would agree with that, which is, going to require the rest of the market to step up and carry the water if that's going to be the case. And you do wonder, we talked several episodes ago before the tariff tantrums, do we need to see a flush? Well, we got that flush. And now you wonder, okay, are sellers going to show up where we are right here, right now? Don't know that.
It's their chance.
You do get a sense that another move lower would really flush out some hands. And the market's really good at that. We'll see.
Well, and what I know, there was a lot of data coming out this last week about who is doing what in April, who is buying, who is selling. And they say in the charts that they put out, the little graphs, that retail was pounding the table through the April lows. So maybe they were right. We'll see.
Yeah. I mean, you're just saying that there's information out there that shows retail's been buying hand over fist for the past few weeks. Meanwhile, institutions and hedge funds have not.
No, still kind of waiting to see how this plays out. Well, and nothing's been fixed, right? I mean, certainly not from a long-term trend following perspective. And it is, and you made such a funny comment yesterday. the last, when did we bottom? It's been about a month now, like April 9th, April 10th, somewhere in there. For the purpose of this conversation, kind of a straight up rally, kind of V bottom ish. And yeah, as a trend follower, and I think we're pretty open, been open for 5 years about how we manage assets, and the 200 day is a big part of that. So to see these, rallies occur under the 200 day and everyone gets a little antsy.
The market's very good at taking you to the edge of your seat.
It is.
Matt, good at max pain. And so this rally off the April lows, even if you're in protective mode, it can be a little bit, and let's say the market rolls over, and we don't know that, but this period of time will be remembered a little bit like hanging inside your house during a storm and watching people outside drive by.
Yeah.
But do they eventually get in an accident because we roll back over? And that's why this 5,600 to 5,800 is so important. Really need to, that's really a prove it level. I mean, we need to see buyers prove that they can overcome supply at that level.
Mm-hmm.
And that's where you have to be patient and wait.
I mentioned this in the client letter as well, but I think it's important to come in mind is that we went to cash in mid-March. We missed the entire tariff tantrum, and we're basically back to where we were in mid-March.
Right.
So it's really been a kind of neutral experience from an account balance perspective.
Right.
If you stayed in cash or you stayed invested, you'd have the exact same account balance today.
Right.
And we're right to the 200 day. We should know within a couple weeks kind of what's going on here with the 5-day and the 200 day moving average. We could even be there next week. Maybe we'll see. I do like that we've I like that we've stopped here and consolidated under the 200 day.
Super healthy. I mean, if we can consolidate here, it might prove that buyers are chewing through the supply.
Yes.
Potential supply, that we're chewing through it and then can push higher. Mr. Market can do what he wants. I mean, the scenario still exists that it rips through 5,600, 5,800. I don't know that that's the more probabilistic outcome, but we've seen stuff like this before. I mean, coming out of the COVID bottom, we saw stocks, V bottom very aggressively. So you always have to be open to that idea. And it's why you use a process. Like, that's fine. If there's enough buying demand to cause that to happen, then we'll be participating again. No big deal.
Well, and the best part of a process is mentally, going into it, all the outcomes.
Right.
Like, we didn't go to cash in mid-March and say, well, gosh, like, there's no way that this is going to rip back higher. I mean, that's definitely, I would say, there's 3 outcomes and they're all equally as possible. Now, maybe differently if you're in a downtrend, is the likelihood of the downtrend continuing, yes. But we sat in cash during the tariff tantrum, and we sat in cash now, and emotionally, it's kind of the same thing. Try, to the best that you can. No one, I think, has the perfect emotions over it, but you're able to lean back on your process.
Yeah, and it goes back to having a plan is better than having a prediction. We have these 3 potential outcomes in the weeks to come, whether it's moving directly through 56 to 5,800, or consolidating at this level, then moving higher, or consolidating and then rolling over. It's as emotionless as having a plan for when you drive home. I don't know if the intersection of Main Street and 6th is going to have a red light when I get there, but I know I'm going to stop if there's a red light.
Yeah.
And if there's a green light, I'm going to go. And it's about emotionless as that.
Do you ever gas? You just pull out a little early and you're like, I think we're going to get a green light in the next 3 seconds. I should be good. I'm going to head and go. Do you do that when you're driving?
No.
No one does that.
Right.
That's called trying to pick tops and bottoms.
Right. Which is a fool's errand. And it's a little bit like process over prediction, or having a plan over prediction is that's what you try to teach your kids, right? I got 2 kids in college, and invariably they're going to be around parties. And it's not about the parties themselves. It's what's your plan before you go into the party, because your parents expect you to be responsible for yourself, for your condition. So have a plan. If there's stuff going on that, have a plan to get out of there.
That party is below its 200 day moving average.
Yeah.
Maybe you don't want to be there.
Right, correct. And so have a plan before you go in, because when you get in trouble is when you don't have a plan. It's when you get caught, stuck in a spot that you don't want to be in, and there's not a great way to get out of there. And it's the same thing with risk management. Have a plan. And for us, we're right in that area where we're watching to see which plan we have to implement. And we will absolutely happily participate and are open minded. If we're closing above 5,800, above a 200-day moving average, we'll happily participate. And that's not the end of the sequence. It's not like then that plan's what happens for the next 12 months, because you could have a scenario where you clear a 200-day and then back below and we roll back
did
over.
that in 2022.
Right. Definitely is a situation. So it's binary thinking. It's having a plan. If this, then that. That way you're not caught in these emotional purgatory situations where you're letting emotion dictate decision making, which can get very
100%.
dangerous.
100%. The process and knowing that you made a decision, right or wrong, absolutely huge piece to not mentally going crazy.
Right. I always like to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets: momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. And so, kind of getting back to some of the nuances that we're seeing in the market. We talked about United Healthcare, and healthcare overall is a little problematic. I'm not saying it needs to be a leader in this market. I think you've done a good job highlighting that it's a mixed sector, as far as some will say, oh, it's a risk off sector.
Yeah.
But you do a good job pointing out that it's got biotech in it, which is risk on type behavior.
Pretty high beta, growthy.
Right. But more specifically, health insurance and biotech.
Terrible.
United Healthcare looks terrible. Elevance, if I'm saying that correctly, ticker ELV, looks terrible. Cigna
definitely looks like it's gonna take another leg lower. I'd be shocked if that doesn't. Yeah, healthcare. And right, this isn't necessarily a new. You and I and our team and always have good fun poking at, Pfizer and Moderna, which have been in free fall for a few years now. Yeah, healthcare does not look good. I am fascinated to see what we have been and continue to be pricing in.
But are you telling me that it's possible that getting free fries in exchange for a vaccine was a bad idea?
Potentially. I think the jury's still out.
Yeah, Pfizer looks terrible. Moderna looks terrible. These healthcare insurance companies look terrible. Biotech looks terrible. I'm not sitting here saying that's bad for the market overall. It's just something that we're highlighting as an interesting sector that's under a lot of duress.
Yes.
And last 2 weeks we've highlighted how the momentum factor is still holding up. That's one for the bulls for sure. That still remains the case this week. Strong upside momentum is not a bad thing. And if those fail, that would probably be coincident with the market rolling back over. And so we have to sit and wait. What else, Ian? What else are we looking at that has your eye?
Momentum's still been good.
Yep.
Broad S&P momentum. Your SPMOs, MTUMs. International momentum too.
Yep.
IMTM, very strong. I saw this morning, but put call ratio, lowest since December 2021.
Really?
That's not what happened after that? And it's not like not trying to do one of those, but it's a data point I like to bring up in here. So when you hit 40-year lows, it's kind of interesting. Bullish percent back above 50 though, which is pretty healthy.
Yep.
Especially, I think it got down to like 18. Does that sound right? I don't have it in front of me.
For a put call ratio?
No, for the bullish percent index.
Oh yeah, that's possible. That's pretty flushy. That's
I
that's definitely a thing.
So the evidence continues to build in the favor of higher for stocks. I will say that. I know you mentioned at the beginning of the podcast, we've had the Zweig bread thrust. Nothing crazy like we saw November 2023. Not that that has to happen. Price is price. But these last two kind of steps that you were talking about earlier, this 5,600 level that we continue to 5,700, 5,650, 5,700. We'll see. But not there yet. On the brink. Is it the start of a new uptrend? Is it a counter trend rally?
Yeah, we will find out in the weeks ahead, but it is interesting to see retail aggressively buying this bounce, a low put call ratio, but in conjunction with a Zweig breadth thrust and a flush in the bullish percent. And so now we watch, we observe. We are the conscientious observers of supply and demand. And so part of it is waiting, which can be the hardest part. I don't know if you've heard that.
Maybe we should just go hang out in Europe. Are we going to have to start having our podcast translated so that, I mean, if we spend the next decade talking about European equities on here, I'm just saying it's a possibility.
Yeah, it is.
It's saying.
100%. Completely agree. And so we have our levels, we have our plan, we have our process. We still below a 200-day domestically. International continues to hold up well, along with crypto. And so now we watch and observe to see what kind of exposure we can have. And we have a really important day coming up this weekend.
All the mothers. Honor
all the
moms.
moms. Yep. You know, the Bible tells us a woman of noble character who can find she is worth far more than rubies. And I was looking up ruby prices, and a 1 carat ruby can be anywhere from $1,000 or $1 million. And I'm going to make an argument that our moms are worth way more than that.
Yep.
So happy Mother's Day to all the moms out there. Thanks for everything you do. You are a linchpin in our societies. What would we do without moms? I have no idea.
I know I would be screwed.
Right. Same here. Love my mom loving me through all the idiocy that I pull off in my life. And she's still there for me. I'm super thankful. I know we're super thankful for our wives who've been great mothers to our children. And so anybody out there listening that's a mom, happy Mother's Day to you, or maybe you're a husband or a son or a daughter. Make sure you squeeze those loved ones this weekend and tell them you love them. Thanks for doing this with me, Ian. I appreciate it.
Have a great weekend, everyone.